Betsson AB, an engaged owner of fast-growing companies in the online gaming industry, presents a unique investment profile characterized by aggressive market expansion, industry-leading profitability, and an exceptionally robust capital structure, and a pronounced market undervaluation. The analysis of its core financial statements, income statement, cash flow statement, and balance sheet confirms a fundamental strength that stands in sharp contrast to the company's current trading multiples. The 2024 fiscal year marked the strongest operational performance in the company's history, driven by strategic focus on proprietary technology and entry into high-growth, regulated markets. Group revenue for the full year 2024 reached €1,106 million, an increase of 17% compared to the €948 million reported in 2023. Critically, organic growth was substantially higher, increasing by 41%, demonstrating significant operational momentum. This expansion was highly profitable, with the full-year EBITDA increasing by 20% to €316.0 million, resulting in an enhanced EBITDA margin of 28.6%. The company's financial resilience is arguably its most compelling feature. The balance sheet is effectively unlevered, evidenced by a significant net cash position of -€139 million at year-end 2024, representing substantial liquidity far surpassing the -€59.6 million net cash reported in the prior year. Furthermore, the quality of earnings is demonstrably high, with operating cash flow, OCF, reaching €272.9 million in 2024, significantly exceeding statutory net income. A key observation derived from the financial statements is the company's ability to achieve high organic growth rates typically associated with highly leveraged, risk-taking enterprises, while simultaneously maintaining a highly conservative, debt-averse capital structure. Expansion is being primarily funded through internally generated operating cash flow rather than external debt, a factor confirmed by the strong 63% equity/assets ratio in 2024. This efficient model ensures exceptional resilience against unforeseen economic or sudden regulatory headwinds, differentiating Betsson from many competitors in the sector. Despite this superior operational and financial health, Betsson trades at enterprise value (EV) multiples that reflect a profound market skepticism. Last 12 months, LTM, EV/EBITDA multiples are reported in the low single digits, around 4.6x to 6.38x. This valuation discount, compared to industry peers, forms the central anomaly of the investment case, suggesting that the market is excessively penalizing the stock for perceived geographic risks, thereby creating a substantial asymmetric investment opportunity. Deep Dive, Income Statement Analysis, 2020 to 2024 Trends. A. Revenue trajectory and strategic diversification. The income statement reveals a robust, accelerating growth narrative over the 5-year period ending 2024. Group revenue experienced a sharp upward trajectory, commencing at $609.3 million in 2020 and nearly doubling to $1,100 million by 2024. The transition from 2023 revenue of $948 million to the 2024 figure of $1,106 million underscores the accelerating momentum, culminating in the best revenue year ever recorded for Betsson. This growth is founded upon a successful product portfolio diversification comprising both casino games and sports betting. In 2024, the product segmentation showed that casino remains the dominant revenue stream, contributing 72% of total revenue. Sportsbook accounted for 27% of revenue and demonstrated strong growth of 14% year-over-year, supported by an improved sportsbook margin of 8.1% for the full year. The ability to simultaneously achieve record casino revenue and robust sportsbook performance mitigates risks associated with cyclical fluctuations or weaker development in a single product category. The company's diversification strategy extends critically to its geographic mix, serving as a primary risk mitigation mechanism. In 2024, the regional revenue split was heavily weighted toward high-growth emerging markets. Central and Eastern Europe and Central Asia (CEECA) was the largest region, contributing 43% of revenue, while Latin America followed closely, accounting for 23%. The remaining segments included Western Europe, 17%, and the Nordics, 16%, confirming that more than two-thirds of revenue stems from regions specifically targeted for growth and regulatory adaptation. This deliberate focus on emerging markets is a key driver for the group's accelerated organic growth. B. Operational efficiency and margin expansion. The expansion in the top line translated effectively into enhanced profitability, demonstrating positive operating leverage. Gross profit climbed steadily, increasing from $309 million in 2020 to $719 million in 2024. Operational discipline is reflected in the accelerated growth of operating income relative to revenue volume. Operating income, EBITDA, increased significantly from $107 million in 2020 to $256 million in 2024, marking a 22% increase year over year. The EBITDA margin for 2024 was 28.6%, a slight improvement from the 27.7% reported in 2023. This high margin profile is indicative of the benefits derived from the proprietary technology platform and sportsbook, which allows for quick market entry and the realization of economies of scale. Simultaneously, the growth strategy required substantial investment in the underlying business infrastructure. Total operational expenses increased, primarily driven by rising personnel expenses, which escalated from $85 million in 2020 to $157 million in 2024, and marketing expenses, which rose from $104 million to $138 million over the same period. This trend reflects the investment required to continually develop offerings, meet regulatory requirements across diverse markets, and strengthen the competitive position. The fact that margins expanded despite these increased expenditures confirms that the new revenue generated in these markets is yielding a superior return on investment, validating the strategic allocation of operational expenses. C. Net earnings and the tax headwind. Statutory profitability also saw strong growth, although the rate was tempered by external factors. Net income reached $183 million in 2024, rising 6% from $173 million in 2023. Earnings per share correspondingly grew to $1.32 in 2024 from $1.29 in the preceding year. A crucial observation regarding the quality of net earnings relates to the dramatic shift in taxation. The total tax expense surged from $21 million in 2023 to $50 million in 2024. This significant rise is directly correlated with an increased share of locally regulated revenue. While a higher tax burden naturally compresses the net margin, this phenomenon is not interpreted as an operational failure. Rather, it represents a strategic success. The company is successfully adapting its operations to comply with locally regulated frameworks, which, though costly in the short term, fundamentally de-risks the business model. By transitioning from non-regulated or gray market revenues toward fully compliant, regulated cash flows, Betsson exchanges a marginal degree of net profitability for significantly enhanced stability and certainty of future earnings, a key factor for long-term institutional investment credibility. I. Cash flow generation and free cash flow assessment. A. Operating cash flow strength and quality of earnings. Betsson's cash flow statement highlights exceptional internal funding capabilities that substantiate the high quality of reported statutory earnings. Operating cash flow, OCF, for the full year 2024 was $272 million, marking an 18% increase over the $230 million generated in 2023. Even quarterly figures demonstrated strong generation, with Q4 2024 OCF reaching $84 million. A critical financial metric is the comparison of OCF against net income. The 2024 OCF of $272 million is nearly 50% greater than the net income of $183 million reported for the same period. This substantial differential confirms a superior cash conversion cycle, primarily driven by the asset-light nature of the B2C gaming business and the non-cash effect of amortization and depreciation expenses, year 2024. This high cash conversion ratio suggests that reported net earnings figures are conservative and that the company's true underlying economic power is better represented by its cash-generating ability. B. Capital Investment and Free Cash Flow, FCF. As an online gaming operator utilizing a proprietary technology platform, capital expenditures, CapEx, are appropriately viewed primarily through the lens of capitalized development costs, investments necessary to maintain and enhance the core technology offering. These capitalized development costs totaled Euro 31 million in 2024. This figure is relatively modest, particularly when compared to the revenue base exceeding 1 billion euros. By using capitalized development costs as a proxy for maintenance and expansionary CapEx, an estimated free cash flow, FCF, can be derived by subtracting this figure from the OCF. The estimated FCF for 2024 stands at approximately Euro 241 million, Euro 272 million OCF minus Euro 31 million CapEx. This estimated FCF figure is exceptionally strong, representing roughly 22% of total revenue. This high level of internally generated discretionary capital provides Betsson with immense financial optionality. This capital can be strategically deployed in various ways, including funding aggressive mergers and acquisitions, executing opportunistic share repurchases, or sustaining the company's liberal shareholder distribution policy, all while effortlessly preserving the existing net cash position. The substantial FCF generation removes any dependence on external financing for growth or shareholder returns. IV. Balance sheet resilience and financial gearing. A. Capital structure and net cash position. Betsson operates with a capital structure that is highly conservative and characterized by profound stability, marking it as a significant competitive advantage within the generally high-leverage gaming industry. The most important metric is the company's gearing profile. At year-end 2024, Betsson maintained a strong net cash position defined by net debt of Euro negative 139.8 million. This negative net debt figure, net cash, represents a material strengthening of the liquidity profile, almost tripling the net cash position recorded at Euro negative 59.6 million 1 year prior. The group's liquidity is further confirmed by the robust cash and cash equivalents balance, which amounted to Euro 308 million at the end of 2024. This liquid war chest was retained even after substantial capital return activities throughout the year, including cash transfers to shareholders via an automatic redemption procedure, which negatively impacted the cash balance by Euro 90 million. Solvency ratios underline this strength. The equity/assets ratio stood at 63% in 2024, a marginal increase from 62% in 2023. This high ratio indicates that the majority of the group's assets are financed by equity rather than debt, providing maximum structural safety and minimizing financial risk exposure. B. Debt management and financial flexibility. Despite operating in a net cash position, Betsson prudently engages in the debt market not to finance operations, but rather for sophisticated liability management. Recent financial activities include the issuance of new senior unsecured bonds alongside a voluntary tender offer and conditional notice of early redemption for existing bonds. Specifically, in 2024, Betsson issued new senior unsecured bonds totaling Euro 100 million with a 3-year tenor, maturing in September 2027. The significance of these debt activities is that they focus on optimizing the cost of capital and staggering maturities rather than covering liquidity needs or funding operational deficits. This reinforces the view that Betsson possesses a fortress balance sheet. This lack of financial gearing and high level of liquidity ensure the company is shielded from adverse fluctuations in capital market conditions and the rising costs of debt, a crucial strategic advantage when anticipating the continued complexities and capital demands associated with regulatory rollouts across high-growth regions like CEECA and Latin America. V. Dividend safety and strategic capital allocation. A. Shareholder distribution policy and proposal. Betsson maintains a clear and flexible policy regarding shareholder returns. The stated ambition of the board is to distribute on one or more occasions up to 50% of net earnings to shareholders, provided the capital structure remains appropriate. This distribution is executed through a combination of mechanisms, including cash dividends, automatic redemption procedures, or the repurchase of own shares. For the stellar performance achieved in the 2024 financial year, the board proposed a substantial distribution. This included an ordinary dividend of Euro 0.657 per share and an additional special dividend of Euro 0.10 per share, totaling Euro 0.757 per share. This reflects management's confidence in the long-term sustainability and continued profitability of the business. B. Dividend coverage and sustainability. The dividend payout is robustly covered by both statutory earnings and, more importantly, by operating cash flows. With earnings per share, EPS, reaching 1.32 in 2024, the proposed total dividend of Euro 0.757 per share translates to a statutory payout ratio of approximately 57%. While slightly above the stated 50% target, this ratio is easily absorbed, particularly given the inclusion of a special dividend component, which is non-recurring by nature. When assessed against the primary metric of liquidity, the estimated free cash flow, FCF, the dividend safety is exceptional. The approved dividend payment for 2025 amounted to Euro 104 million. When this required cash outflow is compared to the estimated 2024 FCF of approximately 241 million, the FCF coverage ratio is well below 50%. This substantial cushion implies that Betsson could withstand a severe operational downturn while still maintaining the ordinary distribution, confirming the high sustainability of the dividend policy. C. The strategic role of share repurchases. Beyond the fixed dividend component, Betsson employs share repurchases as a flexible, opportunistic mechanism for returning capital and enhancing shareholder value. In late 2025, the board initiated a new share buyback program authorizing the repurchase of shares up to the equivalent of Euro 40 million, running through April 2026. This program operates within the bounds of the authorization granted by the annual general meeting, limiting the holding of own shares to no more than 10% of the total. The utilization of share buybacks has been active, with repurchases of Series B shares reported consistently during weeks 45, 46, and 47 of 2025. The strategic value of this program is highly significant, given the company's suppressed market valuation. With enterprise value multiples trading at substantial discounts, the share buyback initiative is highly accretive to existing shareholders, as the company is effectively acquiring future cash flows at a steep discount. This balanced approach, using dividends for consistent yield and buybacks for opportunistic value creation, demonstrates a sophisticated and proactive management commitment to addressing the market's perceived undervaluation. V. Valuation benchmarking and market discrepancy. A. Betsson's current trading multiples. Betsson consistently trades at valuation multiples that appear deeply discounted relative to its robust financial performance and underlying asset quality. The company's last 12 months LTM enterprise value to EBITDA, EV by EBITDA, is reported in the range of 4.6x to 6.38x. Similarly, the LTM EV/EBIT multiple ranges from approximately 5.6x to 6.92x, while the EV revenue multiple is modest at roughly 1.3x. In terms of earnings-based valuation, the current price-to-earnings (PE) ratio is noted to be above the company's 3-year, 5-year, and 10-year historical averages. However, the extremely low EV-based multiples are particularly noteworthy because enterprise value calculation factors in net debt. Since Betsson holds a considerable net cash position, negative net debt of Euro 139.8 million, the reported enterprise value is significantly lower than its market capitalization. This means that the EV-based multiple truly discounts the company's operating power, as the market is failing to adequately credit the massive liquidity buffer and the absence of structural debt risk. B. Peer group valuation comparison. A comparative analysis of Betsson's valuation against major international gaming groups highlights a profound market discrepancy. Flutter Entertainment plc, a prominent player with significant exposure to the burgeoning U.S. regulated market, trades at a vastly higher valuation, reporting an LTM EV/EBITDA multiple of 26.7x. Although Flutter reports a lower EBITDA margin, 17.8% LTM, than Betsson's 28%, its premium is generally attributed to the scarcity value and growth potential associated with its leading position in highly valued regulated Western markets. Entyne plc, another major European competitor, also trades at a substantial premium to Betsson, with an LTM EV/EBITDA multiple of 9.9x. Other publicly traded peers, such as those in the Kindred Group and EVOC, formerly 888 Holdings, generally trade above 7x EV/EBITDA. Betsson's valuation places it at the very low end of the publicly traded online gaming sector, despite its superior margin profile and proven high organic growth rates. C. Analysis of valuation disparity, the regulatory discount. The fundamental driver of this deep valuation discount is the market's perception of regulatory risk associated with Betsson's revenue concentration. Over 2/3 of the 2024 revenue originated from the CECA, 43%, and Latin American, 23%. While these regions provide the high growth necessary to sustain the company's expansion, they are institutionally viewed as carrying a higher and more unpredictable risk of adverse, abrupt regulatory changes, policy shifts, or tax increases compared to the mature and stable regulated markets favored by peers like Flutter. The current valuation multiples suggest that the market is effectively pricing in substantial and permanent impairment of Betsson's future cash flows due to this regulatory uncertainty. However, the operational reality, evidenced by record profitability, successful adaptation to higher tax burdens, and consistently high cash conversion, contradicts this pessimistic assumption. This regulatory concern has created an asymmetric investment opportunity. The gap between Betsson's current multiple, 4.6x to 6.4x, and even the multiple commanded by a mid-tier European peer like Entyne, 9.9x, is significant. Should Betsson continue its successful transition into regulated environments and demonstrate that its cash flows from CECA and LATAM are robustly sustainable, a re-rating could narrow this valuation gap by 50% or more, leading to substantial potential upside. 7. Conclusion and investment outlook. Betsson AB presents a compelling, overlooked investment case defined by exceptional fundamental strength and operational efficiency, combined with a profoundly discounted valuation. The financial performance is robust, marked by record revenues exceeding Euro 1.1 billion in 2024 and industry-leading profitability, evidenced by a 28.6% EBITDA margin. The company's unique capital profile, characterized by an aggressive high-growth strategy executed from a fortress balance sheet with a substantial net cash position, Euro 139.8 million, and prolific free cash flow generation, estimated at 241 million in 2024, provides superior operational safety and financial flexibility. The current trading environment, particularly the LTM EV/EBITDA multiples in the low single digits, indicates that the market has applied an irrational regulation discount. This discount disproportionately penalizes the company for its successful expansion into high-growth emerging regulated markets, failing to fully credit the long-term stability that compliance brings, as demonstrated by the ability to absorb rising gaming taxes while maintaining high margins. The investment outlook is highly favorable for a potential re-rating. Primary catalysts include the continued successful execution of the strategy in the CECA and Latin American markets, solidifying the cash flow base. Furthermore, the flexible capital allocation policy, particularly the use of accretive share buybacks at current depressed valuations, should act to enhance shareholder value and provide a floor for the stock price. As Betsson consistently proves that its revenue streams are sustainable and its cash flows are reliably regulated, the market should be compelled to narrow the valuation gap toward European sector averages, offering significant long-term upside potential.